Typically, when it comes to investing, younger investors want to keep their eyes on total return versus high income. This allows young investors to take full advantage of the power of compounding. However, if you're closer to retirement or have already retired, or even if you're a young investor who wants income today, then you might want to prioritize higher income. In other words, if you're an investor who wants to rely on their portfolio to have a steady stream of income so you can fund your living expenses, you can do that by tilting your portfolio towards a higher yield so you can use that income to pay for your living expenses rather than having to sell shares. The focus of this video will be to go through a strategy and how you can get a higher yield today to maximize your income stream. I'll go over ETFs that you'll want to consider that are providing up to double-digit yields to boost your income. Now, there is no free lunch, and that's why I will go over these ETFs that may or may not make sense for your portfolio. I'll go over both the pros and cons that you want to consider. The first ETF I want to talk about today is called HDIV or HDIV. This ETF was launched back in July of 2021, so it's a relatively newcomer to the land of ETFs, but has definitely caught the attention of income-seeking investors. The objective of the fund is to create a higher income version of the TSX 60 index. It achieves this by using a covered call strategy and matching the sector allocation of the original TSX 60 index and combining that with a 25% cash leverage. This is what allows the ETF to offer a higher yield over the TSX 60 by using a covered call strategy in combination with a cash leverage. Now, there is a major highlight over here that anytime you invest in an ETF that uses a covered call strategy, there is a trade-off between a higher yield today versus total return tomorrow. The way to conceptualize is that if an ETF is trading for, let's say, $16 a share, it may be still trading for that $16 a share price 2 years from now, 5 years from now, 10 years from now. And relative to its yield, that's why the yield is so high, because the share price really isn't moving. So if it's offering a 10-cent distribution or a 15-cent, or whatever that distribution is, it's going to stay the same for 5, 10, 15 years. So the yield is high, the share price really isn't moving. That's why you're trading off tomorrow's total return for cash stream today. And it's not meant for every single investor. There are certain investors who want the income today who are really not interested in total return. Let's dive into these ETFs to see what they're really about. So here we have HDIV, ticker symbol HDIV. It offers a whopping yield of close to 10%, and this is what's really catching the attention of a lot of income investors. And this is offered by Hamilton ETFs. The full name of the ETF is called the Hamilton Enhanced Multi-Sector Covered Call ETF. And their tagline is delivering you more income every single month. And you can see why this has caught the attention of investors, especially income-seeking investors. You get a very high yield, and you get that very high yield distributed every single month. Taking a look at some of the highlights, HDIV has outperformed the TSX 60 by 4.19 annualized since inception. It has a yield of 9.85% and paid out monthly. And the ETF is composed of covered call ETFs with a sector mix broadly similar to the S&P TSX, meaning this ETF is a wrapper of other covered call ETFs. And those ETFs that are within this ETF represent a same sector allocation that is similar to the TSX 60. And on top of all that, it uses a cash leverage of 25% to enhance yield and provide for a growth potential. So what type of investors would make sense for this ETF? Well, if you're an investor who wants attractive monthly income, you want diversification that is similar to the TSX 60 with a higher yield. If you are interested in covered call ETFs, and if you want a higher yield alternative versus a broad-based index strategy. The objective of the fund is to create monthly income and long-term capital appreciation from a diversified multi-sector portfolio of primary covered call ETFs focused in Canada. So to summarize, this ETF focuses in Canada. Its sector allocation is similar to the TSX 60. It implements a covered call strategy and uses a cash leverage to pay out a monthly dividend that has a yield of close to 10%. Take a look at its performance. In the last month, it has performed close to 7% annualized. In the last year, it's been 3% annualized, and since inception, it has performed 11% since inception. Now, you have to take these numbers with a huge grain of salt. As I mentioned earlier in the video, this ETF has only been around since July of 2021, so it doesn't have much of a track record to really understand if this return actually holds out. If this ETF had been around for maybe 5, 7, 10 years, and you're still seeing 11% annualized return, and there's something really there. But with only 1 or 2 years worth of performance, this 11% may or may not hold out. And if you had invested $10,000 since this fund launched back in July of 2021, this portfolio would be worth close to $11,500 roughly. And that's how they're getting that 11.02% return. And this is a part that's catching a lot of investors' interest right here, the higher yield. The original TSX 60 offers a yield between 3 to 4%. And HDIV, by using the covered calls, by using cash leverage, it's able to offer a yield of close to 10%. And so far, since inception, it has been performing relatively well compared to the S&P TSX 60 index. But again, because the performance hasn't been that long, it's only since July of 2021, so about under 2 years, you have to see if this gap holds out or not. It's still too early to tell. And in terms of sector allocation, this is where it's saying that the sector here, in terms of its financial, 32%, utilities, 13%, healthcare at 12%, this is supposed to be similar to the TSX 60. Whereas other individual ETFs hold stocks, this particular ETF is an ETF of ETFs, meaning the underlying holdings are ETFs. So it has a covered call ETF focused on energy, has an ETF focused on Canadian financials, which is Hamilton's own brand. It has an ETF that's focused on gold producer, and these are all covered call strategies. Looking further at fund details, we already talked about this. HDIV is a symbol. It trades on the TSX. It's been around since July 2021. And in a relative short period of time, it has already amassed over $300 million of assets under management. It's a very popular ETF these days. The yield is just shy of 10%, and it pays out every single month. I might be looking at this management fee thinking that it's not that high considering it owns multiple covered call ETFs within its holdings. It also uses cash leverage. But there is more to this number, and we'll talk about why this number you really can't take at face value because it doesn't really show you the whole picture. And we'll get into that in a little bit. Taking a look at its distributions, it started paying a distribution or a dividend of 11.75 cents when it initially launched back in July. So the first distribution was paid in August of 2021. That dividend has grown, and it increased that dividend to 12.5 cents per unit back in February of 2022. And it went up again recently to 13.5 cents per share, and this was increased back in January of 2023. And this is why I find it a little bit more different than other covered call strategies. Usually when I see ETFs that have a covered call strategy or focus on yield, their distributions will be relatively the same. And that could be true for the last 5 years, or the last 10 years. If they're offering, let's say, 10 cents per unit, that 10 cent is likely not to change throughout the holding period of this ETF. But what I find really interesting is that this ETF is able to increase that distribution where it went from 11 to 12 to 13 cents. And what I'm really interested to see is, will this go up further? Because if it's going to be paying 13.5 cents for the next 5 years, 10 years, then in my opinion, it's not really worth it because 13.5 cents may be great today, but 10 years from now, if you're still getting 13.5 cents per unit, you've lost a lot of power to inflation. And as we just saw a little while ago, that this ETF offers a management fee of 0.65%. You really need to dig into the ETF's facts, go through the documents to really find out how much this ETF will cost you. And look right here. The true MER ratio for this ETF is 2.09%, meaning it's as expensive as a mutual fund, which are notoriously expensive in Canada in terms of investments. Here's the thing. The 2.09% is not the whole story just yet still. Wait till we go down further. And here we are, the true ETF expenses. Notice I have to dig down all the way to the ETF fund facts, go to page 3 out of 4, dig through the documentation, read the fine print, and here we are. The true ETF expense is 2.35%, meaning you don't pay these expenses directly, but they do affect you because they reduce the ETF's return. And for this ETF, the expenses were 2.35% of its value. This equals to $23.50 for every $1,000 you've invested. So no matter how well or poor this ETF does, you are essentially losing $23.50 every single year for $1,000 invested. That may not seem like much if you're investing only $1,000, but if you're investing $10,000, $100,000 into this ETF, that adds up. That's why when you look at ETFs, this is one of the key measurement, key ratios, key indicators if an ETF is worth it or not. Do you really want to give up 2.35% in management fees and expenses? And if you want to really compare it, if you're looking at a true TSX 60 index, the expense ratio might be 0.05%, so 5 basis points versus 235 basis points right here. So yes, at face value, this ETF is attractive. It pays off monthly, it pays off a 10% yield, but you really have to read the fine prints to understand what costs to get that yield, and if it really makes sense for your portfolio or not. And before we move on to the next ETF, what's the best way to keep track of some of these amazing dividend ETFs, not only in this video, But even in my other videos that I've talked about, there are so many ETFs out there. There's over 1,000 ETFs available in the Canadian marketplace. And what's the best way to keep track of them all, especially if you're going to be adding multiple ETFs to your portfolio? Well, I have the answer for you. You can now download my custom-built dividend spreadsheet that I've developed for investors like you, so you can keep track of your dividend income, your gains, your losses, and even forecast your future dividend income. I would not be able to manage my portfolio without this spreadsheet, and that's why I built it from the bottom up. So make sure you check out the link in the description today and download a copy for yourself so you can truly measure the results of your portfolio. How well is it doing? As HDIV caught the attention of numerous income-seeking investors, Hamilton ETFs followed up by launching another similar ETF but focused on the US market called HYLD. And similar to HDIV, HYLD has a similar sector allocation but focusing on the S&P 500. It also uses a covered call strategy and using a combination of cash leverage at 25%. Another piece worth noting here is that because HYLD has a higher yield than the S&P 500 index, this particular ETF, HYLD, is more negatively impacted by withholding taxes. These taxes, however, are recoverable for taxable investors, meaning if you're holding this ETF outside of your RRSP, outside of your TFSA, you will get a tax credit for any form of withholding taxes. So here we have ticker symbol HYLD, and you can see this yield is even larger than HDIV at close to 14%. These yields were almost unheard of before Hamilton ETFs got into the game by offering some of the most highest yielding ETFs that I've seen, and one special that pay on a monthly basis. So here's the full name of the ETF. It's called the Hamilton Enhanced US Covered Call ETF, delivering you more US income every single month. A very catchy tagline. So how so this ETF is that it offers a yield of close to 14% with monthly distributions. It has a portfolio of US equity covered call ETFs with an overall sector mix broadly similar to the S&P 500, and it's available for purchase in Canadian hedged dollars, HYLD, or US unhedged at hyld.u. And what type of investors is this suited for, this ETF? Well, if you're looking for attractive monthly income in US dollars or Canadian dollars, but still focusing on the US market, it's diversified in blue chip US equities. It has a higher yield than the S&P 500 with similar volatility, and it offers an enhanced yield and growth potential by using that 25% cash leverage. The objective of the fund is to seek and provide attractive monthly income and long-term capital appreciation from a diversified multi-sector portfolio of primarily covered call ETFs focused on the US market. Taking a look at its performance, it's currently trading around $12 a share and has a yield of 14%. And as you can see, this is such a big disparity between the true S&P 500, which has a yield of less than 2%. By implementing covered calls, by adding some cash leverage, they're able to boost that yield from less than 2% to close to 14%. And if we compare the performance of HYLD to an ETF that tracks the S&P 500, which in this case is VSP, which is the Vanguard S&P 500 Index ETF, you can see so far that since its inception back in February of 2022, so it's been trading for a little over a year now, it has underperformed the S&P 500 so far. And that's my whole point about these ETFs that use a covered call strategy. They may actually lag the S&P or the original indexes because you're getting the income today and a trade-off of future total return tomorrow. And in this case, it's only taken a year to sort of show that disparity. But again, a year isn't really long enough to compare the two ETFs because it just isn't long enough when it comes to world of investing. You need at least a good, I would say, 5 to 10 years worth of performance to really compare two ETFs. And this ETF is much more diversified than its Canadian counterpart, HDIV, by giving you exposure to technology, healthcare, consumer discretionary, and so on. Similar to HDIV, this is also another ETF that holds other covered call ETFs. So you may have heard of QYLD, you may have heard of JEPI. These are some of the most popular US income ETFs. And by investing in HYLD, you're essentially holding some of the most popular US-based covered call ETFs. The neat part about this ETF is that it has caught even more attention than HDIV. It's been around for less than a year, or close to a year, and has already amassed over $400 million of assets under management. Trades on the TSX, so you get to benefit from the US market by holding an ETF on the TSX. Have that yield of over close to 14%. It gets paid monthly. And here we are, management fee of 0.65%. Let's see if we can dig in further to see what the true management fee is for this ETF. When taking a look at its distributions, it initially offered a distribution of 13.75 cents per share per unit back in February when it initially launched, and that distribution has grown to 14 cents today. And as I suspected, the true MER ratio, the true expense for this ETF is over 2% right now at 2.08%. Let's see if we can figure out what exactly is a true total expense of this ETF. And here we are. The true ETF expenses for HYLD is 2.17%, way more than the 0.65 that they have on their cover page. Monthly cash flow continues to be of significant importance for many Canadian investors, and having a sustainable and growing stream of monthly cash from investments is a much sought after goal. Because having your income stream for investments and having it grow every single month, that is the ultimate dream for many investors. And that's why, knowing this, Hamilton ETFs launched another new ETF in the market, offering another high yield on a monthly basis called HMAX. It has a target yield of 13% and is primarily composed of Canadian banks along with other Canadian financial institutions, and also using a covered call strategy to offer such a high yield. Here we have HMAX. As you can see, it has a yield of 13.52%, just shy of the yield of HYLD, and this is the Hamilton Canadian Financial Yield Maximizer ETF. When it comes to these ETFs, you have to remember there's a lot of marketing fluff to attract investors. I mean, who wouldn't want to invest in a ETF that has super high dividend yield maximizing ETF in its name? That name alone will attract many income-seeking investors. The highlights of this ETF is that it offers a 13.52 yield on a monthly basis. It is apparently one of the highest yielding ETFs in Canada, highest yielding financial ETFs. It has diversified exposure to Canada's 10 largest financials with approximately 75% exposure to the big 6 banks. This ETF also uses a covered call strategy to enhance monthly income, and that current coverage is approximately 50% of its holdings. This ETF is a good fit for investors who want that higher monthly income, who want exposure to the blue chip Canadian bank/financials exposure. And because it's a Canadian ETF focused on the blue chip market, the distributions are also tax efficient because of the Canadian dividend tax credit. And it reduces volatility using the option strategy. The objective of HMAX is to deliver attractive monthly income while providing exposure to a market cap weighted portfolio of Canadian financial service stocks. HMAX will employ an active covered call strategy, and HMAX does not use leverage, unlike HYLD and HDIV that have 25% cash leverage. So right now it's trading for around roughly $16 per share, and the yield is 13.52%. And if you take a look at the big banks, on average, they yield between 4 to 5% if you were to hold the stocks yourself. And if you were to use a covered call ETF that focuses on Canadian banks, then you get a yield of 7.82%. But with HMAX, what they're saying is they're able to go from 4.59% from the 7.82%. They're able to offer a 13 plus yield using their own in-house strategy, and they're able to provide higher monthly income with a dynamic covered call strategy, currently writing options on 50% at the money. There's a difference. This ETF will have covered calls out of the money, and HMX is proposing that by using an at-the-money strategy, they're able to offer a high yield. This ETF's only been around for a month or so it's really hard to say that can it actually live up and maintain that 13% yield. It's making big and bold claims, but the reality is it's still too new to tell. There just hasn't been enough time that this ETF's been on the market to see if that 13% is sustainable. This ETF's largest holdings, it should be no surprise, it's in the names, it focuses on the financials. So some of the names you'll see is RBC, TD, Bank of Montreal, Bank of Nova Scotia, Brookfield, and so on. And this is what makes up the ETF. It's been around since January of 2023, and so far it's already amassed over $100 million of assets under management. The management fee is 0.65%. And because HDIV and HYLD are over 2%, I'm expecting that this may be in that similar range, but because it's only been around for a month, it's really hard to tell what that true MER ratio is. Now that we've talked about the 3 ETFs, we've seen what HYLD has to offer, HDIV has to offer, and HMAX has to offer, how can you use this information to actually build a portfolio from scratch? This is what I want to spend some time on, building a portfolio. So here we have the 3 ETFs, HYLD, HDIV, and HMAX. Here are their current respective prices and the current respective yield, and how much you can expect on a monthly basis per share. And this shows you how much you would have to invest to achieve a target monthly income. So for example, let's say you want to achieve $2,000 from these 3 ETFs. Well, if you were to invest in HMAX, you would have to invest close to $170,000 at this current price to get $2,000 a month in income. You want $3,000 a month from HYLD. Then you would have to invest close to $260,000 to get $3,000 per month at its current yield and at a current price. And let's go down further and say, how can you actually build a portfolio using a combination of these three ETFs? Let's do some scenario planning. Let's say you're near retirement and you want to use a combination of all three ETFs and you have an investment of $250,000. What you could theoretically do is, let's say you want to put about 40% into HYLD, 40% into HDIV, and 20% into HMAX. What this shows you is that if you were to use a combination of these three ETFs, you would get these number of shares based on an allocation of 40% and 20% to HMAX using $250,000. You have total shares of 17,571. That will give you a blended monthly income through a combination of these three ETFs of about $2,565. And diversification here is important. I wouldn't put 100% of my money in HYLD. I wouldn't put 100% of my money in HDIV or 100% HMAX. If you really are interested in maximizing your income and you only want to use these three ETFs, it's probably better to consider an asset allocation that breaks down between these three. Again, if your focus is maximizing your income and all you want to is just use these three ETFs as an example, this shows you that you can conceptualize that how much money you would have to invest to achieve your targeted monthly income. If my goal was $2,500, well, I know that I need at least $250,000 to invest 40% into HYLD, 40% into HDIV, and 20% into HMAX to get my $2,500 per month in income. What if I'm not near retirement and I'm actually in the accumulation phase, but I want to focus on income? I'm not really too worried about full income. My focus is just generating a growing stream of monthly income. What alternatives can I consider? Let's take a look at that. So I have here three alternatives to the Hamilton ETF suites. So for example, if I want to focus on the US market, an ETF called ZDY will get me US dividends. If I want to focus on Canadian dividends, I can use something like VDY. And if I want exposure to the Canadian banks, I can use an ETF called ZEB. And similarly, if I were to invest 100% of my money in one ETF, you can see how much I would have to invest to get my target monthly income. So if I'm targeting $1,000 a month, I would have to invest $463,000 into ZDY or $264,000 into ZEB to get $1,000 a month. Let's use these six in combination to determine what a portfolio may look like. So in this scenario, I am an income investor and I want to use a blended combination of all six ETFs. So let's say I want to put some money down and I put 15% into HYLD and HDIV, 10% into HMAX, 25% into ZDY and VDY, and the remaining 10% to ZEB. Well, here are the number of shares I would have altogether, investment $250,000, and here's what my monthly income will look like. Now, maybe I don't have $250,000, maybe I only have $25,000, but I want to keep the same asset allocation. Well, then, if I invest $25,000 in a combination of this portfolio, well, my monthly income would then be $144. So it's really neat to see and play around with some of these ETFs and say, okay, what if I invest more into this ETF or more into that ETF? And what if I only have so much money? What is my potential monthly income going to look like that has a portfolio of these ETFs? And these percentages here is just as an illustrative example to show you what a theoretical portfolio of these ETFs would look like for someone who is not focused on 100% yield, but wants a combination of some little bit of growth and some monthly income along the way. And you know what? I'll actually leave a link to the spreadsheet in the description of this video so you can download a copy today and play around with some of the percentages. You can play around with the investment values. You can play around with the allocation to see what your monthly income would look like if you were to invest in a suite of these ETFs. And as a final example, let's just say you're just starting out and you only have $1,000 in your pocket. What would a potential portfolio look like? So let's see what that looks like. So let's say you only have $1,000. And what would a potential portfolio look like? Well, if I only have $1,000 and maybe I want to spread it evenly, maybe I wanted to do something like 20% here, 20% here, 20% here, 20% here, and I'll put 10% into HMAX and 10% into ZEB. So if I only have $1,000, I can pick up a combination of 48 shares across these six ETFs, and I'm looking at a monthly income of 6.52. That's not bad. So let's say to determine that as an annual basis, if I multiply this by 12, so that means on an annualized basis, I'm making about $78 off my $1,000. That gives me a yield of just under 8%. So there you have it. You have a yield of just shy of 8% using a combination of these six ETFs at this asset allocation. Each portfolio is different and must adapt to your own personal objectives and your own investment values. So my portfolio will look different than your portfolio, which will look different from someone else's portfolio. And it's a good idea to sort of play around with different ETFs before you put your money into the market and say, okay, if I were to invest in this ETF or that ETF, what would my portfolio look like conceptually? I do believe that using a combination of these ETFs, you can complement your portfolio. I would not put 100% of my money in any of these single ETFs because that is just way too much risk for my blood. But you have to speak to your financial advisor, see what they say about your portfolio. Are these ETFs right for your objectives? Do they make sense for your investment horizon? When it comes to building a portfolio from scratch, I highly recommend doing your research, do your own due diligence. If anything, if you don't have the time to do so, speak with a financial advisor, see what they have to say. Speak with a third-party, fee-only financial planner and get their opinion on what may make sense for you. Because no one will care more about your money than you will. Thank you so much for watching. I appreciate you making it to the tail end of this video and sticking with me for so long. I hope you've hit that like, subscribe, and thanks button because it lets me know to produce more content like this. I also have exclusive offers for you in the description of this video. Some amazing discounts and sign-up bonuses, and these are services and products that I use on a daily basis, and I want you to at least, check them out. Again, links to everything I've talked about will be in the description of this video, so you can get a copy of my spreadsheet, my portfolio optimizer, and I'll leave you links to these ETFs so you can check out more facts about them in the description as well. That's it for now. I'll talk to you in the comment section.